Hello class, this is Brian from financialtrainingschool.com and welcome to BO209, Part 2, Hedging Strategies, Reducing Risk Exposure. So as a prerequisite for this lesson, you should watch GT 303, Diversification. And before we start, let's just give a brief recap of Part 1. The hedging strategy in Part 1 focused on expiry, because it allowed you to reduce losses while already in the trade via increasing the number of trades for the respective expiry. Part 2, however, focuses on entry. Thus, this hedging strategy is used prior to trade entry. When implemented, it helps you reduce your risk exposure via risk spreading. As I explained at the end of GT 303, which you should watch, risk spreading is essentially diversification within your position, e.g. breaking up your trade into smaller amounts between high and low probability levels. Note, this is not the same as Part 1. You might be thinking both strategies increase your number of trades. While that may be true, the actual amount of risk is different, which I'll illustrate on the next slide. Part 2 isn't intended to be a substitute nor a complement to Part 1 explicitly. You could use one or the other or both. It's completely up to you to decide how you want to implement hedging strategies. So here's the difference between Part 1 on the top and Part 2 on the bottom. Part 1 we basically dealt with you enter at the high probability levels only. One put at the top, one call at the bottom, done. That's it. You can still apply the same concepts in Part 2, but here's the difference. Basically, if you have low probability levels and high probability levels, you can split your trades up. So previously you have one $10 put at the top, now you can have two $5 puts. One at a low probability level and another one at the high probability level. So that's the main difference between Part 1 and Part 2. So here's the thought process behind reducing risk exposure. While trading, you'll usually only trade high probability setups, but from time to time, price gets exhausted and doesn't quite reach your high probability level, thus forming a new high probability level, but it's lower than the previous high probability. So this strategy essentially lets you trade these lower probability levels by splitting up your trades. As shown on the previous slide, you could end up with consecutive same direction trades, which at first glance contradicts the strategy in Part 1. This isn't true because when you add up the total risk amount, it's the same. In Part 1, you'd only place one put of $10 at the resistance level, whereas in Part 2, you'll place two separate puts of $5 at the low and high probability levels. As long as you don't violate your money management rules, then splitting up your trades doesn't contradict the alternating trade rule from Part 1. So, as you'll recall, in Part 1, I said you should only place a put, then a call, then a put, then a call. Here, if you're splitting it up, you'll have put, call, put, call, something like that. But the two puts add up to the same amount as the one put from before. So it doesn't matter. As long as you don't contradict your rules, then you should be fine. So in a sense, reducing risk exposure is more of a money management strategy because you're reallocating your resources based on different probability levels for your trade. Splitting up a big trade into smaller trades is essentially the same as reducing your trade size. Rather than take a $10 trade, you could take two $5 trades as illustrated previously. There's no limit, by the way, to how many times you split it. It's completely up to you. The only problem is that when you split up trades is whether or not you're able to enter all of them at the appropriate levels. So it's best to keep it simple, split it up into 2 or 3 trades max. Lastly, something else to take into account is your broker's minimum trade size. If you're trading the bare minimum of either $10, $25, whatever the minimum is, then you can't really split up trades. You can only implement this strategy if you're trading above their minimum trade size. So to end off this lesson, let's go over some scenarios just like I did in Part 1. All 3 scenarios revolve around the concept of missing trades and how you could possibly adjust and adapt to the new levels. As I mentioned in GT 208, Emotions, not trading is actually a form of trading. So knowing when not to trade is very useful. So let's say for scenario number 1, you only trade high probability levels. So if you don't adjust your levels or split your trades, then you'll be missing quite a few trades due to price forming new levels and you fail to adjust. So as you can see in my illustration here, the resistance is above, the support is below, the blue lines represents the start and end of each expiry period of 30 minutes, the red line is the lockout period of 5 minutes. So here we only place high probability levels. So we only place trades if it's before lockout and it touches the black lines above and below. So here we place, this is the only put we place because these highs here don't reach our high probability level. So you're missing these trades here. And that's the problem with scenario number 1, if you don't adjust and adapt. In scenario number 2, you adjust your levels and you split up your trades. So let's say price forms the new lower probability levels and you start splitting up your trades, reserving $5 for the new level and $5 for the old level. So here we have the high of the new level, starting from here, and that's the new high. Basically, you put $5 puts on the new level and $5 on the old level, and you keep consistent for the whole way through. So you place $5 every time it touches the red line and $5 every time it touches the black line. So you place $5 here, $5 here. Since it doesn't reach the black line here, you don't place a second trade, but it does for the first trade expiry. Now the question becomes, if the new levels are permanent and become the new high probability levels, do you stick with splitting up trades or do you adapt to the new environment? E.g., do you regret not putting your normal trade size of $10 on the new level? So that's what the third scenario is for. You adjust your levels and you start adapting after a few trades. Since the second trade expiry didn't go up to the old high probability level, you figure that maybe a new level has formed permanently. Thus, you adjust your trade size back to normal and place the full $10 trade on the third trade expiry. So previously, we're going to flip back to the previous slide, you had 5, 5, 5, 5. In the third scenario, you have 5, 5, 5, and then you adjust and adapt to the last expiry and you place $10 going back to your normal trade amount for the new level, because this is now your new high probability level. So that concludes the three scenarios. Just some final notes before we end off the lesson. Like everything else in trading, reducing risk exposure is subjective because it deals with risk management. If you put 100 traders into the same room and half of them identify the same level to enter the trade, I guarantee you how each of them enters the trade will be different due to everyone having their own risk tolerance. As I mentioned in the introduction, how you implement hedging strategies is up to you. Part 1 for the most part is widely accepted as a straddle. Part 2 is a little weird because some people might argue not to bother with low probability setups or dislike the idea of reducing their trade size. So, as I mentioned before, it's completely up to you. If you want to complement the two strategies to your own trading strategies, that's fine. You want to substitute part 1 and part 2, up to you, that's fine, as long as it works for you. So that's it for this lesson. As usual, my recommended brokers are 24 Option, Bank to Binary, and Trade Rush. Make sure you guys use my links to sign up so that you can get an hour free tutoring with me. Full details can be found at ftstutor.com. Hope you guys enjoyed this video, and I will see you guys next time.